Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Okay, good morning, everyone, and welcome to Tax Tuesday for Wealth Coffee Chats. My name is Anthony Wolfenden. I'm a tax financial advisor, and we are coming up on the end of the financial year. A lot of folks are considering making contributions to super as a tax deduction. This is a good idea generally, and indeed the time is short to get that done. Remember, industry funds close their doors to contributions for this fiscal year, sometimes a week or two in advance of the end of the fiscal year, which means you might have a week or so left to get this done. Now that brings up interesting conversations about how contributions are taxed. And so today I'm going to spend a little bit of time talking about something called Div293 tax. This is not Div296, the proposed tax on super balances above $3 million that is in the press so much at the moment. But interestingly, if we listen to the justifications for this, it'll sound very familiar. So Div293 is a tax that was introduced in the federal budget in 2012-13 under the Gillard government, and it was designed to make the super system fairer and more sustainable. Does that sound like anything we've heard recently? Perhaps. It was modified in 16 and 17 in the federal budget under the Turnbull government, and the threshold for the tax was reduced to $250,000. The threshold, you ask. Well, we'll get into that in a minute. But let's go over the rationale for introducing this. The government will reduce the tax concessions that very high income earners receive on concessional contributions to tax, to superannuation, I beg your pardon. So the contributions are normally taxed at 15%. High income earners are taxed at 45% plus 2% Medicare levy. So the difference between those two numbers is 32%. And the government decided that they would like to snaffle up some of that for clients who met the thresholds, which we'll talk about in a minute, the thresholds and the calculations. Here's a summary of the government position in 2012-13. It was introduced to only take a little bit of money from very, very, very high income earners. The measure would only affect the top 1.2% of tax holders initially. Don't miss that word, initially. Now, over sort of 13 years later, it's not 1.3% of income earners, because the tax thresholds are not indexed, are they? It was a part of a suite to improve the retirement system, etc. Modest and reasonable reforms were claimed at the time. This is something that's also being claimed for the $3 million Div293 tax that's currently going through Parliament. Okay, so how is it calculated? What goes on? So basically, there's a threshold in the fiscal year for income for Division 293 purposes. What does that mean? Income for Division 293. Well, normally when we think of our income and how it's taxed in the federal system, it's your taxable income. And you would think that that's how it works for 293 purposes. That is not actually true. So what they do for the calculation to see if you're going to pay some extra contributions, extra tax on your contributions to super, is they take your taxable income for the year, they add in any fringe benefits that you might have, they add back all of your investment losses. So you don't get to claim any deductions to reduce your taxable income. That's all gone. So it's your total income plus any foreign income. And then they add to that any super contributions you make as well. So this is your grossed up income plus your superannuation contributions. And if that number exceeds $250,000 in the fiscal year, then you will be subject to Div 293 tax. Now, it is graduated in the sense that if your total income without super contributions is below $250,000, then they'll only tax the extra 15% on contributions for your super contributions that exceed 250 and go above that. Yeah, that gets all a bit funky. There's some math in there that needs to be done. But the way this is impacting property investors particularly is if you've sold a property and you've made a reasonable capital gain, and reasonable, doesn't have to be much to take your income for the year minus any deductions you've got plus super contributions well in excess of $250,000, what will happen is they'll want some tax. So super contributions are normally taxed at 15%. And one of the strategies or tactics we have at the end of the fiscal year is we can normally contribute money to super and have super pay tax on that income at 15% instead of us pay tax at our marginal rates in big income years. In income years where property is sold, the tax on the super contributions jumps from 15% to 30% in many cases, and the differential is not as much for people looking to save on their tax bill. So let's sort of bracket this and get a bit of an understanding around it. I mean, at most, if your income with super contributions and a capital gain is, $500,000, you've made a big capital gain, then they'll charge an extra 15% on your super contributions in total, which could be up to 30 grand. And so the most you'll ever pay under this tax is $4,500. So that's if you've made a massive gain on a property, it's not going to necessarily be super noticeable. So understand the total, that you're exposed to, about $4,500. It is a tax that's only on concessional contributions to super, which is usually, for most people can't exceed sort of $30,000 in a year. And you can't reduce it. You can't remove it. No deductions that you have apply because they add back deductions for calculation purposes. And so it can be a little bit, noticeable that way. If you are subject to this tax, you don't pay it in your tax return. This is a calculation that's done at the end of the fiscal year. They look at your contributions to super, they look at the income they can see, and the ATO basically issues a notification indicating that you're subject to 293. You'll get it in the mail. It's wonderful. It'll turn up and say, hey, you've got to pay some extra tax. They are a little bit flexible about it. They will let you pay the tax from your bank account. They'll also elect or allow you to elect to have the money released from your super account. You don't have to be retired or have met a condition of release for the ATO, obviously, to tax what's in there. And so they can take the tax from there. So it's hard to avoid. It is a known value pretty much for property investors. But if you think you're going to save a lot by putting money into super, you get to save a little bit less. So the way I think about this is with a tax of up to $4,500 on super contributions in a year with a big gain, instead of the differential between the $30,000 you might be able to put in being up to 32% tax saved, if super's taxed at 15% and you're taxed at potentially 47 when you've made a big gain, the difference in tax rates there on 30,000 you might be able to contribute is 32%, because the ATO charge you an extra 15% on your super contributions. The differential between your personal tax rate on a big gain and what super takes is now only 17%. When I say only 17%, that is still really quite a big saving. And so my suggestion to clients is to consider making super contributions in a year that you've made a big capital gain, because you still save on tax. You just don't save on as much tax as you would think, because the government would like to share in your wealth, I guess is the way to put it. We'll talk about Div296 shortly, which you can see that the rationale for the two taxes is quite the same. They start off quite low, not impacting many people. They don't index the damn things, or they bring the thresholds down, and then it starts impacting more and more people. So if you get a chance to talk to your senator, that's about the only place they can stop this thing happening now. Please take that opportunity. Okay, that's it for the Wealth Coffee Chats today on Tax Tuesday. Div293 Tax. Can't avoid it, but it's not necessarily going to stop the strategies that you have in saving on capital gains. Cheers.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.